What's going on, everybody? It's Jeff here. Welcome back to the channel. Almost going from that red to green close. Still finishing up for the week. We were down just under 1%. In this video, guys, I really want to talk to you about two specific things. One that is very important, and it has to do with a new treasury policy. The deadline is July 30th. I want to talk a little bit about that, what it might potentially mean for the entire market, not only our stock, but in the entire market, and how to be able to hedge your portfolio in case the inevitable does happen. So let's get right into it. First and foremost, guys, let's take a look at this chart. Absolutely beautiful. This does not look like a Friday chart for AMC at all. Normally, a little bit of volatility in the morning. Once it's about 1 p.m. Eastern time, it's just a natural sell-off, as volume dies out. So it's really nice to see low of 34.69, getting up to that 37.50 level. We were green for a little bit, and like I said, finishing down just 1%. One thing I want to point out to you guys, absolutely crazy, was the SPY, which is the S&P 500 ETF, hit another all-time high, 440.30, which is absolutely insane because Monday it bounced all the way back to that 50-day moving average and came back insanely strong. Expect this pattern to continue. A little bit more of an increase, a little bit of consolidation, right back to that 50 moving average, and it'll probably continue that pattern for a little bit until something drastic changes. But as you can see here, guys, this is something very important for you guys to follow, okay, whether you're in investing in any stock, is once it breaks that 50, expect it to immediately go to the 100. It breaks that 100, expect it to immediately go to the 200. That is going to be a large drop to where we are at. I mean, this would be, what would be down here? 47 points. That would bring us right into correction territory. Remember, we are in the second year of the bull run. The NASDAQ had hit its 10% correction territory. However, the S&P did not. Okay, and the likelihood of the S&P hitting a 10% correction during the second year of a bull run is very likely. So keep that into the back of your minds. I tell everybody in our private community, if you're interested, first link in the description, when it is a great time to play a couple different, options plays to really hedge against your portfolio. And a lot of guys that they're picking it up, they're seeing it, and they're absolutely crushing it. If you're interested, guys, first link, come check it out. We'd love to have you. But let's get into what I want to talk about. I want to briefly, very briefly, guys, talk about the rule filings. I know some of you guys are saying, hey, listen, they're not even enforcing them. Well, I really want to compare this to a criminal, trial. Okay, think about a murder trial. You might have the murder weapon. There might be, witnesses. There might even be a mere confession. Okay. However, the process still has to go on. And a lot of times these trials take a long period of time. You got to make sure every T is crossed, every, I is dotted, and nothing else in that, there's no rippling effect. Nothing else gets affected. They want to make sure they don't absolutely crush the economy. They can't just act irrationally and quickly because manipulation was first found. All right. So I don't believe that they're not enforcing these. I want to talk about this new one, 803. It talks about SFTs, which is securities financing transactions. And to give you a brief overview, let me just scroll down really quick, give you a brief overview. Basically, what they are doing right here, which broadly speaking, securities lending transactions where parties exchange equity securities against cash and simultaneously agree to exchange the same securities and cash. So basically, there are two parties literally agreeing that they can transfer back to each other, and they're going to give it right back to each other. There might be a little bit of a fee for the transaction in order to oblige, or to be compliant with anything that is needed, their liquidity issues. Okay. Now, this, if you literally read this and read just a couple pages, the SEC, the NSCC, they all know exactly what's going on. They know why they're doing it. It even says right here, it understands that SFTs provide liquidity to markets and facilitates the ability of market participants to make delivery on short sales and thereby avoid failures to deliver, naked shorts, in similar situations. It understands what's going on, but it's literally stating that this abuse is not going to continue. Okay. However, like I said, everything takes a little bit of time. This article right here, you can go check it out by the Tokenist. It goes into much further in depth about another topic that we've been covering a lot, and it literally gives, okay, the SEC chairman some of his quotes talking about what's going on, what's happened, okay, and what the abuse might be. So go check it out, guys. It's by the Tokenist. I'm not going to cover it because it's going to take too long of time, but this is the title right here. Now let me get into what I really want to talk about that came out today. Secretary of Treasury Janet Yellen sends letter to congressional leadership on the debt limit. Okay, today the Treasury is announcing that it will suspend the sale of state and local government series securities at noon on July 30th. The suspension of these sales will continue until the debt limit is suspended or raised. Let me bring you over to another article that explains this thing a little bit more clearly to you guys. Right here, U.S. Secretary Janet Yellen urged lawmakers on Friday to increase or suspend the nation's debt limit as soon as possible and warned that if Congress does not act by August 2nd, the Treasury Department would need to take extraordinary measures to prevent a U.S. default. Okay? Reread, literally pause this video, reread exactly what was written. Literally to prevent a U.S. default. When you're talking about all-time highs for freaking jobless claims, okay, you've got all-time high. Look at the housing market, amount on margin, our debt ceiling. I mean, everything is just all-time. I mean, everything's all-time high. I mean, there's nothing that's not all-time high. There's nothing that's just like, oh, we got a little issue over here and maybe a small issue over here. It's just everything is boom. Okay. And it's literally acting as if this is urgency. It talks a little bit, go check it out. Like I said, this is by Reuters. You can go type this up and check us out and read this for yourself, so I don't take too much time. Talks about the suspension of such sales and so forth. Okay. And it wants to basically suspend or increase the debt limit, failure to work out differences among lawmakers over whether government spending cuts should accompany an increase in the statutory debt limit. Okay, currently set at 28.5 trillion. Failure to do this, what's it going to cause? Let me tell you exactly what it's going to cause. Or it's going to cause one of our favorite plays right here to absolutely rip. Okay, and if you look at what just happened on Monday, all right, I covered this, a monster rip. I talk about playing the VIX on that Friday, and it was an absolute monster of a play. If you are on a platform that does not have this, okay, then I'm sorry, you're not going to be able to get in on some of this fun, because like I said, not all brokerages offer this option as a VIX. The other play that I want to talk to you guys about, and I'm going to make this absolutely public, is this one. XLF, okay, this is a financial ETF, and it goes off of pretty much banks. Like I said, a financial ETF. All right, this is the 3-year chart. You can see what happened in 2020. We are insanely overextended, and it is starting to form a little bit of a bearish pattern on the weekly. Even if you go over to the 1 day, it looks like that it is acting as resistance on that 50 moving average. Wait for that to curl. Touch that 100 moving average. That is what you call a death cross, when you have a smaller moving average, a shorter moving average cross a longer moving average in the negative. That is a death cross, which is opposite to the golden cross. Okay, so one of these plays that I have is an extended put. Okay, on this one, I've already profited as of just Monday. I opened up another position. This is one of the positions that I like to say that I will use my muscle, all right, to make sure I become profitable, meaning it's a long-term play. If you want to go check it out, like I said, come join the group, because I'm not going to just tell it to everybody, right? Because I know some individuals are really happy that I shared it with them. So, but it is a long-term options play, running a short play on this. I will continually add to my position, all right, to make sure my cost basis begins to get lower. And once we get that little pop, then we're able to secure a nice profit. All right. And the reason why we do this is because maybe we'll be able to get out of our Apples and our Teslas and whatever else you're invested in outside of AMC, but it's going to be down from where it was. So in order to kind of make up some of that difference, it's nice to have short plays that get a little bit of a pop. Your portfolio kind of stays net, let the markets kind of find out which direction it's going, and then choose to invest accordingly. So guys, that's it for this video. I'll see you in the next one.